Scene script. Picture yourself lending money to a friend. In return, they promise to pay you back with some interest after a specific period. That's essentially what a bond is. Now let's delve deeper into this concept. Bonds, in the simplest terms, are like IOUs. They're a form of loan where investors lend money to entities. These entities could be corporations wanting to expand their business or governments looking to fund public projects. In exchange for the money, these entities issue a bond, making a commitment to pay back the original amount, also known as the principal, along with some interest. The interest is the cost of borrowing, and it's the issuer's way of saying thank you for lending them your hard-earned cash. This interest, or coupon as it's often called, is usually paid at regular intervals, say annually or semi-annually. The term of the bond, or the length of time before the issuer has to pay back the principal, is known as the maturity date. This can range from a few months to several decades. Once the bond reaches its maturity date, the issuer has to pay back the principal to the bondholder and the bond ceases to exist. Now, here's the exciting part. Bonds are not just a one-time transaction between two parties. They can be bought and sold in the bond market, much like stocks in the stock market. So if you buy a bond and later decide you need your money back before the maturity date, you can sell it to someone else. However, remember that the price of bonds can fluctuate in the market. So you might end up selling it for more or less than what you paid for it, but that's a topic for another day. So, in a nutshell, when you buy a bond, you're essentially becoming a creditor to the issuer. Interesting, right? Now, you might wonder, how do these bonds really work? Well, let's put it in terms of something more familiar. Buying a house or a car. When you take out a mortgage to buy a house, you're essentially borrowing money from the bank. The bank, in turn, expects you to repay this loan with interest over a set period of time. Similarly, when a government or a corporation issues a bond, they are borrowing money from investors with the promise to repay it with interest over a certain period, known as the bond's term. Now, imagine the interest on your mortgage or car loan. This is akin to the interest rate on a bond, more formally known as the bond's yield. Just as you'd pay the bank interest on your mortgage or car loan, the issuer of a bond pays interest to the bondholder. This interest is often paid semi-annually and forms a steady stream of income for the bondholder until the bond's maturity date. But what if you want to sell your house before your mortgage term ends? The price someone is willing to pay for your house could be more or less than what you initially paid, depending on various factors like the housing market conditions and the state of your house. Similarly, bond prices can fluctuate based on market conditions such as interest rates and the creditworthiness of the issuer. If interest rates rise, the price of existing bonds typically falls since they are less attractive compared to new bonds offering higher yields. If the issuer's creditworthiness deteriorates, the price of their bonds may also fall as investors demand a higher yield for the additional risk. So, just like your home loan or car loan, bonds involve borrowing and lending, but on a much larger scale. They offer regular income to investors and allow governments and corporations to raise funds for various projects or to finance their operations. In the next scene, we'll delve into the critical role bonds play in the economy. Stay tuned. Now that we understand what bonds are and how they work, let's dive into their role in the economy. Bonds are more than just financial instruments. They are economic engines, powering a wide variety of activities and projects. Governments and corporations alike rely on bonds to raise capital. When governments need to fund large-scale projects like infrastructure development or public services, they often issue bonds. These bonds, known as government or sovereign bonds, are purchased by investors, providing the government with the necessary funding. Similarly, corporations also use bonds to raise capital for a range of operations. Whether it's for expanding their business, funding research and development, or even managing day-to-day operations, corporate bonds can be a viable financing option. They offer a way for these entities to acquire funds without diluting ownership through issuing more shares. But what's in it for the investors? Well, bonds provide a steady income stream. When you buy a bond, you're essentially lending money to the issuer. In return, they promise to pay you a specified rate of interest during the life of the bond. This regular interest payment, or coupon as it's often called, can be a reliable source of income for investors. Moreover, bonds also add diversity to investment portfolios. You've probably heard the old adage, "Don't put all your eggs in one basket." This rings true in the world of investing. By including a mix of different types of investments, like stocks, bonds, and cash, investors can spread their risk. If one sector of the market goes down, the other parts might still perform well, offsetting potential losses. Now let's shift gears and talk about how the bond market influences the broader economy. The bond market plays a key role in determining interest rates. When demand for bonds is high, prices rise and yields, which move inversely to prices, fall. This leads to lower interest rates, making it cheaper for individuals and businesses to borrow money. Conversely, when bond demand is low, prices drop, yields rise, and so do interest rates. The bond market also has a significant impact on economic growth. It provides a channel for both public and private sectors to access capital. This capital can be used to invest in infrastructure, innovation, and other economic activities that can spur growth. Moreover, the bond market can act as a barometer of the economy's health. If investors are confident about the economy, they're likely to invest in riskier corporate bonds, signaling a positive economic outlook. So, from funding massive infrastructural projects to shaping economic policies, bonds play a pivotal role in our economy. Before we wrap up, here are some key points to remember about bonds. Bonds, in a nutshell, are loans that you give to either governments or corporations. When you purchase a bond, you're essentially lending money to the issuer for a set period of time. In return, they promise to pay you interest periodically and to return the principal amount at maturity or end of the loan term. Now let's briefly recap how bonds work. The issuers sell bonds to raise money for various purposes, such as funding public projects or expanding business operations. As an investor, you earn income from the interest payments, also known as the coupon rate. The rate can be fixed, floating, or zero, depending on the type of bond. The bond's face value is returned to you when the bond matures. Bonds play a vital role in the economy. They provide a stable source of funding for governments and corporations. For investors, bonds can be a safer and more predictable investment compared to stocks. They can also help diversify an investment portfolio, reducing the potential risk. However, investing in bonds is not without risks. Bonds are subject to interest rate risk, credit risk, and inflation risk, among others. If interest rates rise, the market price of bonds will fall. Credit risk refers to the possibility that the bond issuer might default on their payment obligations. Inflation risk is the risk that the returns from the bond might not keep up with inflation, reducing the purchasing power of your investment. But remember, the rewards can be substantial. With a well-chosen portfolio of bonds, you can enjoy regular income, capital preservation, and even capital appreciation in some cases. In conclusion, bonds are a cornerstone of the financial markets and a key component of a well-diversified investment portfolio. They provide investors with a range of options to suit their risk tolerance and investment goals. Remember, bonds are not just pieces of paper. They are powerful financial tools that can help shape economies and secure your financial future. In the world of finance, understanding bonds is like learning the alphabet. It's the foundation you need to navigate the complex financial landscape. Let's take a moment to recap. Bonds, whether issued by governments, corporations, or other entities, are essentially loans you give with the expectation of getting your money back with interest. They play a critical role in the economy and can be a valuable part of your investment strategy. As we've seen, bonds have practical applications in our daily lives, from funding public projects to helping corporations grow. The key takeaway: understanding bonds sets you up for financial success. So don't stop here. Dive deeper. Explore the different types of bonds, how they fit into your investment strategies. With that, we've just scratched the surface of the bond market. But remember, every financial journey begins with a single step. Keep learning, keep investing, and keep growing.